So the big question is this: how do investors like us who trade options and manage our own money generate income regardless of where the stock market goes, and do it all in a way that lets us make time for the people and things we love, and yet still build wealth and remain profitable? That's the question, and this podcast will give you the answer. I'm your host, Kirk Duplessis, and you're listening to the Daily Call from Option Alpha. Hey everyone, this is Kirk here again from Option Alpha, and welcome back to the Daily Call. Today we're going to answer a question, which is, what's the point of leaving out-of-the-money options on to expire worthless? So if you've been following any of the trades that we typically like to do, we do a lot of spread type trading, whether it's iron condors, credit spreads, iron butterflies, etc. And sometimes when we get into these positions, we will exit the positions by just simply buying back the inside strikes. So for example, if we're doing an iron condor, we'll buy back the short call and the short put, and we'll leave the outside out of the money options on to expire worthless. Now, why do we do this? Well, in many cases, when we do this, we're doing this when those out of the money options are not worth any value anyway. So they were added as protection, they were added for a very cheap premium, and they still are probably worth almost no premium at all. So it might take a little bit more time to fill if we were trying to fill all of the legs together. And if we did fill all the legs together, maybe we get $1 worth of value out of these out of the money options. It's just not worth a lot of premium to spend time and energy and waste an opportunity to close the inside kind of real risk of the position for a potential profit. So we'll leave these out of the money options on to expire worthless. Now, again, the point of this is that one, it's harder to fill these out of the money options as you get closer to expiration. So why would we sacrifice the rest of the position just to fill $1 worth of value in an out of the money option? But the other reason that we leave them on is because I think they act as little long lottery tickets and black swan event kind of hedges. So if we have a bunch of out of the money options, we close the inside strikes, and then randomly the market goes bananas, we at least have a little bit of protection on either end from these out of the money options. Now, is that always going to happen? Are we always going to have that? Highly unlikely. In fact, I think it's only really happened twice before in the last 10 years, EWZ, and then I think the other one that we had was Netflix, and Netflix had a huge move after we closed an earnings trade, and we ended up making money on the out of the money options. But again, it's not the standard rule. It's probably the exception too. But again, it's not hurting you to leave these out of the money options on to expire worthless as part of the positions. They act as little black swan event, kind of hedge protection. They don't have any value anyway, so probably in many cases might cost you more in commissions than the actual options have in value. So that's why we leave them on. It's not we're not trying to play the market long. We're not expecting these huge moves in either direction. We just are trying to be very systematic and logical in how we go about closing positions for the most premium possible. So hopefully this helps out. As always, if you have any questions, let me know. And until next time, happy trading. Thanks for joining us on the Daily Call. Be sure to subscribe right now for more daily options trading ideas, strategies, and tactics to help you learn how to place smarter, more profitable trades. And if you like what we're doing, don't forget to give us a rating and a review so we can continue to bring you the best daily content possible. We'll see you again tomorrow, right here on the Daily Call from OptionAlpha.com.